Hey guys, Chess and Wine here on Thursday, February 10th, 2011. I'd like to do a brief video market recap for you. I wrote a post earlier today alerting you to this. It's a bit zoomed out here, this chart, but it's a 5-minute chart of the SPY, ticker symbol SPY, the actively traded ETF for the S&P 500. And I described this inverted head and shoulders pattern here. Left shoulder, head, right shoulder tends to be a bullish setup so long as what's known as the neckline, as you can see right here, it should be pretty obvious in this chart. I'm drawing this white line here right through it, is breached to the upside and held. You get kind of a measured move there from the neckline down to the lows of the head, and you just kind of extend that up, and that's kind of your measured move higher. Now, what's interesting is towards the end of the session, really in the last, I don't know, 10-15 minutes of the session, with kind of the events in Egypt unfolding, the market really looked to be breaking out here and kind of confirming this inverted head and shoulders bottom. And then all of a sudden, again, this is a 5-minute chart, so keep in mind this short time frame. We had a sharp reversal lower, followed by kind of the bulls salvaging a close literally right at this neckline. So the point is this: it's going to be really interesting going forward, especially tomorrow, how we open, how the market comes to terms with this short-term pattern. Now, I kind of juxtapose that 5-minute bullish setup, the head and shoulders inverted head and shoulders bottoming pattern, with what could be construed as a bearish head and shoulders topping pattern on the 30-minute chart. So you always want to keep these time frames in mind. Now, obviously, what's interesting is if this inverted head and shoulders bottom is confirmed to the upside as a bullish move, then obviously this head and shoulders topping pattern is going to be negated, and that's going to be very bullish for the market. So these are all things. It's a good reason why you want to put time frames together, and that can give you, if you just look at the daily chart here, you won't have nearly as much perspective on the broad market as far as the S&P 500 and the SPY are concerned than if you'd looked at those shorter term time frames. So it's always constructive to do that. Now, as far as the broad market, sure, it's a bit whippy up here. We open low. We tend to all dips are kind of being bought, but at the same time, we're not quite seeing the kind of vigorous action with sustained breakouts and positive momentum that we saw earlier on in the rally. Here's the NASDAQ composite. Again, at the earlier stages in this rally in September, October, November, even early December, I would argue, we had much more vigorous action, again, with breakouts being sustained. As we've kind of matured during this uptrend, the individual setups have kind of dwindled in terms of the hot areas of momentum that have really been rewarding traders who play high probability setups. So it's been a bit whippier market, and I think even though we're still in an overarching uptrend, as you can see, the NASDAQ, the S&P, they're above all of these rising moving averages. Again, that's something to be aware of underneath the surface. Now, what's interesting is a divergence I've been discussing for a long time. The Dow Jones transportation stocks, they came in, they were diverging from the broad market, even spending quite a bit of time below the 50-day moving average. And today, they kind of popped their head up above what was resistance up here around 5150 on the Dow Jones transportation average. So that's something to monitor to see if we get some follow through there. But of course, with the bullish there, the bearish clearly aspect of this market, the emerging markets are clearly flashing some troubling signs here. This was a key support trend line dating back several months. Was breached today with another kind of move lower. Now, the 150-day moving average is directly below, but I would not be surprised at all. In fact, you could argue I would expect a test of this 200-day moving average down here. So this is overall a very sloppy chart. Likely it needs a lot of time, even if the uptrend is, even if this isn't the beginning of a major bear move. It needs some time to heal before it moves higher. In a similar kind of situation with the Russell, as far as the NASDAQ and the S&P, a bit choppier than usual than we've seen prior in the rally, but overall the uptrend remains intact, albeit with the whipsaws and lack of proliferation of high probability setups underneath the surface.